Imagine waking up tomorrow and a quarter of your entire investment, your retirement, your savings account, simply vanished. Not over weeks, but in a single day. That's exactly what happened on Black Monday 1987. But the real story isn't the traders screaming on the floor. Before AI took over our lives, a secret algorithm called portfolio insurance nearly took down the entire global financial system. On October 19th, 1987, this unseen code triggered a domino effect that wiped out over $500 billion in a matter of hours. This is the story of how machines went rogue and how we learned to tame them.
The year is 1987. On the surface, America is booming. It's the era of Reaganomics, tax cuts, massive military spending, and a hands-off approach to Wall Street regulation fueling a historic, multi-year bull run. The mood is one of unstoppable financial success. But underneath the glossy surface of big hair and even bigger profits, the foundations were getting shaky. Reaganomics meant massive government borrowing, leading to a ballooning federal debt and a crippling trade deficit. To defend the rapidly sliding U.S. dollar and control rising inflation, the Federal Reserve, under its new chairman, Alan Greenspan, started steadily pushing interest rates up. Higher interest rates are like a slow-moving financial poison. They make borrowing more expensive, slowing growth, and make guaranteed return investments, like bonds, look much safer than volatile stocks. By the autumn of '87, global investors were nervous. The U.S. dollar was sliding, and everyone was looking for an exit. But a simple, natural correction was not what they got. They got a cataclysm, thanks to a dangerous new invention. The real dynamite that turned a market correction into a global panic wasn't economic policy. It was a new tool called program trading. And within that, the key culprit was a mathematical strategy known as portfolio insurance. This invention was designed for massive fund managers. Historically, if they saw a stock drop, they had to manually sell millions of shares, a slow, expensive process. Portfolio insurance changed everything. It was a computer model that automatically sold stock futures, a bet against the market, when prices started to fall. The key phrase is automatically sold. It was meant to be a perfect hedge, letting big funds lock in gains without ever having to liquidate their physical stocks. The theoretical benefit was elegant: protect your portfolio with an invisible hedge. The crucial, fatal flaw was the assumption that no one else would be doing the same thing at the same time. The model was designed to kick in when the market dropped, meaning that when the selling started, the algorithm itself would force more selling by converting a small problem into a big one. If 5% of the market was using this insurance, it would be fine. But by late 1987, huge institutional funds, controlling well over $100 billion, had placed their faith entirely in the hands of this untested, self-fulfilling prophecy of collapse. They had effectively wired the entire market with an automated trigger. The market didn't fall off a cliff without warning. The month of October was punctuated by severe market jitters, each one a test that the system failed. On October 14th, a day nicknamed Bloody Friday, the DJIA tumbled over 95 points. That was a massive drop for the time, and it was enough to activate some of those portfolio insurance models for the first time. They dutifully started selling futures, causing unease, but the market held, barely. Just 2 trading days later, on October 16th, another wave of selling hit, pushing the market down another 108 points. That Friday was so brutal, the New York Stock Exchange actually faced calls to keep the markets closed over the weekend to allow things to settle. They refused. As the weekend of October 17th and 18th arrived, the air was thick with tension. Traders and fund managers knew the systems were volatile, but they were bound by their algorithmic instructions. The technical selling pressure was immense, and the economic news out of the U.S. was dire. Monday, October 19th, 1987. The weather is gloomy, mirroring the mood on Wall Street. Every nervous investor, every trader, and every single programmed algorithm is poised over the sell button. The market opens sharply lower. Within minutes, the algorithms sense the drop, and the automatic forced selling begins. Not just by one fund, but by a domino chain of dozens of massive institutional funds all following the same flawed code. But this time, it's not a small correction. This time, the speed, scale, and sheer volume of the selling orders overwhelmed every single system Wall Street had in place. The phone lines jammed, the computer systems froze. The machine was now in control, and it was about to drive the market into a single-day loss that remains unprecedented in history. The opening bell rings at 9:30 a.m., and the disaster is instantaneous. The fear from the previous week's mini-crashes turned into outright catastrophe, driven not just by human panic, but by the cold, unfeeling logic of the machine. The market immediately plunged. As the Dow dropped, the portfolio insurance algorithms, which are the digital dominoes we discussed, kicked in as designed. They automatically generated massive sell orders for stock futures. The problem was immediate. There were no buyers left. This triggered a catastrophic loop. Futures prices collapsed, which signaled to the programs that the underlying stocks must be falling further, prompting the algorithms to force even more selling in the stock market to maintain their hedge. This forced automated selling overwhelmed the entire financial ecosystem. The market was experiencing unprecedented illiquidity. Trading systems were overloaded, causing massive delays. On the trading floor, specialists couldn't answer phones. Brokers couldn't get price quotes. Traders were screaming, unsure if the price they saw was seconds old or minutes old. The market mechanism, the core engine of capitalism, had simply seized up.
The destruction was swift and global. Because of the time differences, Asian and European markets were already open, and the news from New York, when it finally broke through the system delays, was devastating. The shockwave hit every financial center. London saw massive losses, but the worst immediate panic was felt in the Far East. Hong Kong, for example, was hit so hard, authorities were forced to shut down their market for 4 days just to prevent total meltdown. Black Monday was the first true moment proving that financial panic could travel across continents at the speed of light. Back in New York, the carnage continued unabated all afternoon. The Dow Jones Industrial Average, the bedrock index of American industry, began its terrifying, record-breaking freefall. By the closing bell, the catastrophic damage was tallied. The DJIA had fallen 508 points. That single day's drop represented a stunning 22.6% decline. It remains, to this day, the largest one-day percentage loss in the history of the Dow Jones.
The next morning, Tuesday, October 20th, the world held its breath. The crisis had moved from the trading floor to the central bank. The man who stepped into the leadership vacuum was the newly appointed Federal Reserve Chairman, Alan Greenspan. Greenspan made a crucial and historic decision. He understood that the crash wasn't caused by fundamentally worthless companies. It was caused by a complete lack of liquidity, the breakdown of the financial plumbing. The Fed issued a one-sentence statement that is legendary in financial history. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. This was more than just words. It was a powerful signal that the Fed would literally print and inject vast amounts of cash into the banks to keep the system from locking up entirely. By guaranteeing that banks could access cash, Greenspan broke the cycle of panic selling and allowed buyers to cautiously return to the market.
Thanks to Greenspan's intervention, the market rebounded surprisingly quickly. But regulators knew they had to build a permanent safeguard against the algorithmic terror that caused Black Monday. The solution was the circuit breaker. The concept is simple. When the market falls by a certain percentage, e.g. 7%, 13%, or 20%, trading is automatically halted for a set period. This forces everyone, humans and algorithms alike, to stop, process the news, and regain some order. Circuit breakers are the direct, tangible legacy of Black Monday. They are the emergency brakes built into the engine of global capitalism, put in place to ensure that the speed of the machine can never again outrun the ability of humans to manage the chaos.
Black Monday was terrifying, and the losses were immense. But ultimately, it was a technical disaster. It was a breakdown of systems, the protocols, the algorithms, and the plumbing that connected buyers and sellers. The fundamental integrity of the banks and the core value of companies were largely intact. That is the crucial distinction we must hold on to. In 1987, the problem was speed and structure. 21 years later, the world would face a financial crisis where the problem wasn't speed, but corruption and a structural rot deep within the financial system itself. That crisis, the 2008 global financial crisis, would prove to be far more devastating, permanently changing the way we view debt, housing, and risk.